If you run a small business, or even if you're just interested in getting a better understanding of financial statements, then this is the video for you. The financial statements give us so much information on the company, such as how well the business is performing financially, how many staff are employed by the business, details of assets owned by the business, how it manages its cash flows, etc. From the business owner's point of view, we can use this information to measure growth, communicate our core messages and values within the director's report section, as well as use our balance sheet to show lenders that we know how to manage our cash and that it would be a sensible move to lend us that £1 million loan. So come with me as I run through 3 main important areas of financial statements which will arm you with the knowledge and expertise to look at any company's financials and instantly understand how they are performing. Stick around to the end to absorb everything. By the time we finish, you'll be armed with the superpowers of knowledge that helped make Warren Buffett a multi-billionaire. Don't forget to hit the like and subscribe button. Hi, I'm Bradley Lay, a finance director and business coach, specialising in 10xing small companies and creating wealth for business owners. If you want to use your business as the vehicle to wealth creation, then let's start with understanding financial statements. Firstly, the income statement. This section of the financial report shows us how profitable the business has been, which is basically looking at revenue or turnover, then taking away your business expenses or costs to give us the profit made during the period. So it's telling us firstly if we are profitable, secondly if we are efficient, and thirdly how much money we have made. And this is the most important metric. We are in business to make money. If the income statement is showing a loss or a significant downtrade, then we know we need to take immediate action. We have 2 types of profit shown in here: gross profit and net profit. The gross profit is the profit we have generated in our business performing its operations and deducts cost of sales, or what's also known as cost of goods sold. These are the costs directly related to the project, goods produced or general operations, or simply the money we spend to make money. If we were, for example, in the business of cleaning windows, the cost of the window cleaner, the materials they've used, plus any other travel expenses incurred in performing the act of cleaning the windows. A very high level and very simplified way of looking at gross profit is that it gives you an indication of roughly how much of a return to expect before deducting overheads for every £1 or dollar in revenue your business generates. To calculate our net profit, we take the gross profit, as just discussed, and then deduct our overheads and finance costs. Using the same example with the window cleaner, the overhead costs would include items such as the cost of marketing the business, cost of any office or rent, and the cost of phone calls, etc. We would then arrive at a net profit, which is the overall profitability of your business. This figure will tell us if we are running our business successfully, and if not, what costs are preventing this. This information will also allow us to make better decisions going forward. Secondly, the balance sheet. This section of the financial report shows us how healthy our business is. It's a list of assets owned, liabilities the company has in the future, and a statement of equity, i.e., and I am oversimplifying this, what the business is worth. These figures all fit together in the equation liabilities plus equity equals assets. We can interrogate the balance sheet to answer questions such as, does our business have cash and for how long? Are we able to pay our bills and our liabilities? Are we in debt? And possibly we may not even have realised. In terms of assets in our business, the more we hold, the better, as there are a number of finance borrowing facilities currently available to businesses in which the lender will secure a loan against these assets. This is referred to as asset-backed finance, and typical examples of assets which we could use to raise finance against include motor vehicles, property, plant and machinery. Some other examples of other assets in your balance sheet would include the following: stock or inventory, which if your company is in the business of selling products, this would be the value of unsold stock. If you're in the business of selling services, this stock amount would be referred to as WIP, work in progress. And similarly, it's the value of projects being worked on and not yet complete or billed. And then other assets that may appear on our balance sheets are licenses, trademarks or goodwill, debtors, i.e. the customers which we've invoiced, which haven't yet paid. And of course, the greatest asset of all, cash. Our balance sheet also lists our liabilities, which are debts the business owes and are due for payment in the future. The balance sheet will also show if any of these liabilities are due for payment past 1 year, like say for example a loan. This is why the liabilities on the balance sheet are split into current liabilities, amount due under 1 year, and long-term liabilities falling due past 1 year. Some examples of liabilities include creditors or accounts payable, i.e. your suppliers due for payment by your business who have offered you credit terms, income tax, VAT, employment taxes, credit card debts, mortgages and other long-term debts. In terms of equity on your balance sheet, this shows how much profit the business has made in its lifetime, less any dividends or similar equity payments. I am simplifying this, but in essence it is a reflection of what the business is worth. It is the amount that would be left over if you sold all of your assets and paid off all your debts. Therefore, if this figure is positive, then you know the business is doing a great job. Thirdly, statement of cash flows. This section of the financial report shows us how cash has flowed through the business during the period. It is a statement showing the starting cash, adding receipts and cash made, and then subtracting cash spent to give us the closing cash position. These cash transactions are further broken down into 3 separate business activities. Finance activities. These are the flows of cash used to fund the company, usually focused around debt, equity and dividends. Any capital raised from banks, investors or shareholders also shows under financing activities. So in summary, investments, dividends received and or paid, and loans received and or paid. Secondly, our statement of cash flows will have operating activities listed as another heading. This refers to the amount of cash used and received around the company's ongoing regular business activities, such as manufacturing and selling goods and services. Other amounts included within operating activities would include items such as rent, income tax, and employee pay, etc. We then have the third type of activity on the statement of cash flows being investment activities. This is the section of cash flow that shows the cash generated or spent relating to, you guessed it, investments. This would include items such as purchase of physical assets like plants, machinery or equipment, investments in securities, or the sale of these assets and securities. So in conclusion, in terms of your whole cash flow in general, we want to be asking ourselves, is the cash flow positive or negative? If negative, then why? Are the operations of your business strong enough without financing or investments? I hope you've enjoyed watching this video today. Don't forget to hit the like and subscribe button to this channel. Please feel free to watch some other content, which I hope you will also enjoy. Thanks for watching, and I look forward to seeing you again in the next video.